Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And it is just the two of us today. Brian, we're going to go into a couple of topics today. There's two of these specifically are already like top headlines, like national news kind of headlines. They're not just real estate and mortgage related. I mean, they are related, but they are going way outside the field of our industry. So
Ooh, I think everybody's trying to get a piece of this.
yeah. So here's the four in order, but then we're going to go with that order. But there are two that are at the top of everyone's topic list, which is the commission lawsuit number one and insurers leaving California. Most recently, State Farm announcing another round of people getting non-renewed.
Yikes.
So. All right, from the top here, we have home buyers and sellers to be spared automatic broker commissions under a $418 million settlement from CNBC. You got home builder sentiment turning positive for the first time since July. Then how mortgage rates have changed during the Fed hikes, and State Farm to pull out of 72,000 more, I'm going to say more, California insurance policies coming in from Insurance Business Magazine. First time on our show with Insurance Business Magazine. Also, I have to say, too, quick pit stop at the Fed topic. By the way, the Fed is not the most important thing we're going to talk about today.
I know, right?
That's weird, but also all things considered, this is there are some definite problems with what is happening in real estate and mortgage and around it third party, which most people aren't even talking about, but there are ripple effects abound. So there are ripple effects abound? I don't know. Ripple effects abound. Here we go. At the first one, we have home buyers and sellers to be spared automatic broker commissions under $418 million settlement. Can I say something at the top?
Yeah, let's see it.
What is automatic about a broker commission? I mean, that's already from the beginning. That's like not even a proper representation of what the heck this whole thing's about.
So it was interesting because I was reading through it, and the first thing that came when they say it automatic, I'm like, well, you can say no and interview a few other people and then kind of gauge where you're at, you know? So it's like, unless the value that they provided for that percentage made up for, what it is that they're selling for, then okay, then you got sold. It made sense.
So essentially what happened here is that the National Association of Realtors agreed to this settlement that what they say eliminate real estate brokers' longstanding automatic commissions, commonly up to 6% of the purchase price. Mm-hmm. But the real issue isn't just the commission itself. It's whether you can have how it's paid as part of this. And then if it is done this way, it can or cannot be on MLS. There's all this other stuff that's going to get like figured out, but some of it's super unclear. But also, I will tell you right now, some of the let's say unintended consequences are super clear. So let's talk about some of those. First of all, it says home buyers and sellers would be able to negotiate their fees with their agents up front. Like, when was that not the case? Like, honestly, when was that not the case? I know that let me clarify the top. I'm sure some people may have felt that they were handcuffed to having to pay a certain commission, or maybe they didn't want to, fight for themselves and kind of vie for a lower commission to sell or buy or whatever. But like, this is already at the top. Like, people are able to negotiate their fees. Whether or not you get what you want doesn't mean you are unable to negotiate. That's already a problem in this.
So one of the things that right off the bat, and I'm not trying to play devil's advocate or choose one side or, favor with the other side, but I will look at it like if someone's presenting to you a document that's a contract, right? Everybody knows, read the fine print, read every single thing. Even if they're breaking it down to you and explaining it to you as a responsible financial move, you should still always read the paperwork. And in the paperwork, you'll see that you're able to negotiate your pricing, and it's not automatic. So by the time that you meet with the realtor, you should have already pre-prepped and know more or less what to expect. Because if you're going into the meeting and you don't know anything about real estate, then anything they say could be true.
Well, okay, and let me clarify. I'm not saying that I'm not advocating that consumers should have gotchas. And
No.
Sorry, you're a sucker and you're an idiot.
Not at all.
That's not what I'm saying at all. But it's not even proper to say that they will be able to negotiate fees up front now that they always have been able to.
Yeah.
Now, again, this comes down to the agent that's sitting across the table with their listing paperwork with you saying, here's my listing agreement. And then whether or not they go into detail over the listing agreement commission fees, how much the buyer is getting offered, it's not always equally split. There are some things that in this article they don't go into, but it's like, first of all, it's not always 6%. Sometimes it's 5, 5.5, 4, whatever. And then it's like, oh, well, it's split down the middle. That's not always the case either. Sometimes it's a 6% commission and it's 2.5 and 3.5.
And I mean, just from experience, like I've gone to listing presentations with my realtor partners, and they break down everything and they give the option to the seller, like, hey, this is what you get if we go with this price. This is what we get if we go with this price. So there, at least for the instances that I've seen, there is options. Now, there obviously you pay for what you get. And that's across the board. So if you pay someone a 1% to sell your house, you're going to get a 1% service, 2%, 3%, 4%, 5%, so on. So at the same time, you don't have to get, glued to the first agent that you speak with. So I think there's so much more information out there that I think at the same time, it's a give or take. You should also be more prepared when you're meeting with the realtor.
Well, and it's disingenuous to also say that this is going to drive down commission prices. That's not the case. What they're basically is saying, you can't pay, the sellers don't need to pay for the buyer's agent anymore. No. Well, that's fine. So, buyers are going to now have to pay for their agent on their own, which means that the buyer-broker agreement is going to come into heavy play, or there's going to be some other, well, I shouldn't say or, there will be some more creative solutions that come to the market on how buyer agents can be compensated because they are doing sales work. They are representing your side of the deal. Yeah. This concept that the buyer's agent is nothing more than like an Uber taxi driver just letting you see things is false. Yeah. There are buyer's agents that go to bat for you when your 100%. Appraisal comes in high or low and have to renegotiate terms, or when you have specific terms that are outside of the financing that need to be negotiated, or when you get your repair work back, or your home inspection back, and there's repair work that needs to be done, or there's price adjustments, or whatever. There's so many other things that go into this that it is unfair or untrue to say that commission prices are going to go down because the workload isn't going down at all.
On the contrary, I feel like at times they put more time into it than anything.
Well, and I think how the money gets to the buyer's agent is really going to be the thing that has to change here. But, the other thing, just I'll say mechanically speaking, is when there are less people that perform a task, usually the more they're compensated, not less. So it's kind of the law of supply and demand. Like when you do something or a specific trade where there's not very many of you, and let's say the talent is scarce, then you usually get paid pretty well to do that.
I think it comes down to like the lawyer model, right? Where if you want to get your case solved and you want to be dismissed, you're going to go and hire the best. You're not just going to hire someone that's not that good, right? Just because it's going to save you money, you might also lose.
Well, that's another unintended consequence of this. It's like, so those who have are going to have better? Yeah, probably. Once again. But here's the thing. To that degree, to that argument, and I'm not saying you're wrong. I'm saying you're right. If you have more means and you need to buy $1 million house and you can fork out the money one way or another in the deal, outside the deal to pay your buyer's agent, then you're probably going to get a good deal, which then I'm going to say asses out the people in the middle class and the poor.
Hey, you're being honest.
Once again. So here's an issue. And the argument that this is going to like reduce home prices, that's not true either. Like, no, the home price doesn't include the amount that goes to the buyer's agent.
So those are like, great, I'll take that home.
The price is still the price. and the thing is that even if people are going to try to negotiate a higher price even in order to get the buyer's compensation or the buyer's agent's compensation paid for somehow, well then there's still the affordability issue and you have to qualify.
Yeah.
And this is still going on like right now in the middle of also how to even insure homes in California right now at higher premiums that are already putting duress on people's qualification standards. It's becoming like this like crap cake. And
oh god!
And I am not necessarily. I am obviously not happy about this, and I'm also complaining. But I'm saying this because like buyers agents help people get into homes, and there are very few people that have enough real estate knowledge, contract law knowledge, and day-to-day front-of-the-lines knowledge to represent themselves in a sale. Even if you went and bought from a for sale by owner and you did it
even
on your
worse.
Own, well, good luck. Maybe or maybe not. I'm not going to say it's worse or better, but I'm saying here's my point: is unless you are like the 1% of 1% of 1% of 1% that you can self-represent yourself as a buyer in a real estate transaction, great for you. But that is not the case for the majority of people in the market.
So I'll give an example that I heard over the weekend. So it's a listing agent, right? And he's trying to work with the unrepresented buyer. So the listing agent says, great, send me your purchase contract, send me your terms, and let me know when you can get the inspection done.
Right. Yeah.
The buyer then goes, how do I do that?
Right.
I don't know. Didn't you want to do this yourself? And then, okay, go call your lawyer. Lawyer's charging me $5,000 to get this paperwork done and help. Okay, pay them. I don't have that money. Okay, then hire an agent. Right. So it almost like you're down the line, you're going to have to need some representation, because if I go to the doctors, I'm hoping the doctor knows what's wrong with me, because I don't know what's wrong with me. If I go to a mechanic, I hope the mechanic knows what's wrong with my car, because I obviously don't. And if I try to do it myself, it might cost me more and I might lose out on more money. So I feel that honestly, down the line, you're going to have to upfront negotiate what you're worth as a buyer's agent, which I think is okay because now you're letting everything upfront. Hey, this is what my services cost. This is what you're entailed if you want to work with me. But this is also why I'm worth that much.
Yeah.
So I think in a way, it does squeezes out all the people that, unfortunately aren't strong agents, and they need to be a little bit more assertive the way that they, handle their business, because now it's not an automatic, hey, you shoot a contract, it gets accepted, you're going to get paid by the seller. Now it's an upfront thing that needs to be spoken about, because I feel for the longest time, the buyer side could just kind of squeeze away with, hey, you're not paying me, they're not paying me, the seller's paying me, so my work for you is free. But the counter argument to that is that the buyer's still paying for that buyer's commission fee. It's just wrapped into the loan and the purchase price.
Right. That's already how it is.
So it's like at the
You're
end of the
already buying
day,
the house at the price that includes the commission
is
to the buyer's
seller
agent.
really paying for that, or is the buyer rolling it into the purchase price that they're buying for the house?
It's both. I mean, it's both and, because it's a handoff, right? Because the seller's taking less money on the sale of their house, so they're basically paying for it. But the buyer's also buying it at a higher price than they would if there was baked in there, right? So it's a both and. I understand it mathematically, and some of these people in the comments will be like, no, it can't be both. I understand what you're saying. The point is, the price of $1 million includes 3% to the buyer's agent in this example. And then could it be $970,000 if there was no buyer agent fee? Yeah, it could be. But then the person's also still netting less money on the sales side. Now, I am unfortunately I'm very skeptical that this is going to lead to better transactions. I think this is going to cause more problems when it comes to things that are undisclosed or overlooked or unknown, and buyers who do not have the correct representation could find themselves in a bad position because they are unable to pay, or there's no other way for that commission to be paid, so they can't have proper representation in escrow.
Yeah, and unfortunately for me, the three most demographics that I feel will get affected by this is first-time home buyers, VA buyers, and first-time investors. Because if you don't have, as a first-time buyer, it's almost very difficult to get that down payment. Then once you get the down payment, you're like, great, I got the down payment, I got closing costs. And then closing costs is going to run you another 2 to 3% on top of the 3.5%, 5%, depending on how much you pay down. That's the minimum. Then you're telling me you're going to have to then fork out another 2.5%, 3%. Where's that money coming from if they're already struggling right now with savings and coming up with a down payment and closing costs? So that's also going to be addressed, and a lot of people, unfortunately, are going to lose, because now they're going to be, I don't have money to pay for my house down payment, I don't have money for closing costs, and now I don't have money for freaking representation.
Well, it's going to have to come down to some sort of exchange, whether it is an increased price or increased down payment or some sort of like seller compensation in order to compensate, agent on record, whatever it might be, some way of navigating money from the net sales profit from the seller side to the buyer agent is going to have to happen, because it is baked into the price, if you will. And also, here's the other deal. You brought up the VA thing. We have to talk about the VA thing because we predominantly do VA here, VA purchases and refinances. The VA handbook prohibits a VA buyer from paying their agent. Now, the new rule means the buyer must pay their agent. So how is it that a VA borrower is going to be able to pay their agent when they're not allowed to pay their agent?
So like you said, this is just going to open a whole bunch of can of worms that we didn't think were there, and now they're going to be problems that weren't problems before, and now that's going to cause another problem. So then that has to get fixed down the line somehow, whether they're going to wrap it into the loan, they're going to switch the law up, but
it's gridlock. It right now, as it stands, it's gridlock,
you can't do nothing,
because you have to either change the VA rule or there has to be an exception for this new rule that does not apply to VA. So of these two immovable forces, one of them is going to have to yield to the other.
It's like creating a solution, but another problem over here.
Well, the solution is the problem in this case, right? Because the VA rule has to change in the VA handbook, which will allow the VA buyer to do that. Or this rule has to create a clause that has an exception for VA buyers to yield itself to the rule that's in VA right now. They both cannot exist is the point. Yeah. So VA buyers, here we go, for our active duty and our veterans who served our country, let's make this more difficult for them.
Even more.
Congratulations. This, and here's the deal. This F's the sellers over too. Yes, I had to say it that way instead of the way I wanted to, because what happens, and this happens here in San Diego, and I was just texting with somebody about this today, is in San Diego, because our cost of living adjustment is so high, married active duty combined BAH allows them to afford in San Diego.
Oh, yeah, 100%.
And sometimes their offer is the best offer. So if their offer on the table is the best offer to the seller, what's the remedy to a seller who can't accept it? What's the answer?
Paying the commission.
Right? You don't
paying the commission.
Paying the commission, right?
Paying the commission.
Right. So here's why. Let's go back to $1 million home example. Like $1 million active duty, yes. Depending on their,
we're doing it, we're seeing it, and it's happening.
Yes, it's happening because their combined BAH is enough that they can easily cover that with the BAH. But here's my point. If the offer from the married VA couple comes in and it's the best offer on the table to the seller is then being denied their ability to take the best offer because of this rule. They'd have to take the second or third best offer, which may not be VA, but because it's not VA, allows them to be able to accept it. So this undermines sellers in that situation.
So doesn't that discriminate against somebody because of the fact that, hey, I don't have money, therefore you can't show this house now? Like, yo, that's not...
Well, I think that's part of what they're trying to do. This is trying to create an equal playing ground, a level playing ground by saying that based on the amount of commissions that are paid to the buyers, some buyers agents don't show certain properties. But in the end, here's my argument with that. Whether the commission is 2.5% to a buyer agent, 2%, 3%, whatever it is, your goal is to put your buyers in a home. And if you show them a house that has a higher commission that they hate, they're not going to make an offer.
Yeah,
regardless. If you show them a house that they love and they are willing to do anything they want to get into it, and the commission is 2%, guess what? You're closing a deal at 2%. That's the bottom line.
Yep.
And the argument in the article is that, well, agents are taking their clients to more expensive places. That's also a misrepresentation of what's going on.
That's why we're here in the first place.
That agents are taking their clients to places that pay higher commissions regardless of price. But you still have to go down to the rung of the ladder where you have to get to the nuts and the bolts of the math and go, do they even qualify at the higher price, higher commission place? They may not. So in the end, I honestly think this is a bunch of bullcrap. And I don't even benefit from this in either way. Honestly, we don't benefit. We don't benefit or lose in this. I am definitely taking a side that I think this is stupid and it's a big waste of money.
It is.
Also, what level of reconciliation comes to people who this happened to 10 years ago, 15 years ago, 20 years ago? How far back are we going to go? Because $418 million doesn't cover more than a couple years, I'll say.
Yeah.
I don't even remember. I'm sorry. On the show, I don't even know how many years this is going to go back and like kind of claw back. But it's not going to cover everyone that's ever bought a house. So that also has a line in the sand on who even benefits from this stupid lawsuit.
And then again, if you say, okay, I opt to go with the seller's agent, like it's okay, I'm going to go with them, I'm going to get a better deal if I just go with the seller. Cool. So the listings agent job is to represent the seller, negotiate the best terms for the seller, and sell the house at the highest price possible.
Yes.
The buyer's agent is responsible for negotiating the best deal for the buyer, hopefully saving some money and bringing the price down, and negotiating the best terms
and conditions.
So where is the benefit if it's a conflict of interest? If one's trying to get it higher, the other one's trying to get it lower with the best terms.
I think what's going to happen is that listing agents who mostly right now in a demand market have the upper hand anyways are going to have even more of an upper hand.
Yeah, of course.
What they could do is just double in deals and do a good job. And then maybe have a sub-representation for someone to represent the buyer either in their agency or on their team or something like that. So really I think, okay, hey, well, instead of 6% commission, we'll do it for 4.5 or 5, and we'll double in the deal. We'll have someone else represent you on this side. So at least there's, let's say, some sort of equal representation. Even if it's under the same roof or the same name of the company.
That's not a bad.
I don't know how that's going to work, honestly. I think there is something to be said about other, I will not name them, but other brokerages that have referral structures inside their company where agent A can refer to another agent to represent a buyer that they can't, and then they can pay a commission referral fee for that. I think some of those agencies are going to have a leg up in this. I don't know how this is going to, I don't know what this is going to do to the Redfins and Zillows and
Well, I feel like they're just getting squeezed out because their margins are not going to be able to, they're getting dried up.
Well, yes, but I think that opens up a different conversation of how they make their money because it's not just that they're making money from selling homes. There are software companies. So they're software companies that are 100% reliant on MLS data porting into their service in order to show people homes online. So it's not just that they're making money because of, sales. It's marketing, it's data, it's a bunch of other things.
And who would always pay all these big marketing dollars to Zillow? Buyers, agents, people that want to get leads.
Yes, it's agents, it's advertisers, it's all sorts of other things. I'm saying it's a whole different conversation than this one. I'm not saying we can't have it. It's just that we can go down that rabbit hole and end up there where the point here for the broker commission thing is that number one, people were not held at gunpoint to sign up for this. Number one, okay? If you were, comment below, DM us, and we'll apologize. I'm so sorry that happened to you. That should have never happened. And I'm glad you made it out alive to be able to make that comment. Number two, this is not always the case where people are locked into paying the fee. It's not always 6%. It's not always split down the middle. And this definitely does have repercussions beyond the lawsuit itself. Specifically for what we do with VA buyers, there have to be workarounds that come up really quick because some of these things are going to take effect this summer, and we're only a couple months away.
I honestly think that the way that they word these articles and they push out these news, it's so that it hits consumers in certain feelings so that they could prompt themselves, say, yeah, you know what, the real estate industry is doing this. Yeah, they're bad.
Yeah, but I mean, I understand, like, one of the attorneys in here said, like, it's a bribe. Like, I understand their argument. They have to say crap like that to try to, kind of, lay their case out for everybody who's going to decide
in the
this.
same ballpark, but just different
fine.
structure.
But
they still somehow get a commission themselves off a settlement. But
look, I've said this on other shows too. It's like, are we going to do this to the auto industry too?
Yeah. Oh.
Like, let's talk about salespeople in the auto industry. Are we going to completely undermine them and pull the rug out from underneath them, and that they shouldn't get paid because of the work they do? Like, I don't care whether you love or hate the car industry or love or hate car salesmen. When you're not buying a car, you're buying a hundreds of thousands or in the $1 million home. This is, for most people, their largest asset, their biggest monthly payment, their largest tax deduction when it comes to being able to deduct mortgage interest and property taxes, et cetera, et cetera. Mm-hmm. And now we're saying, oh, let's make it even more difficult to do the thing that we call the American dream. I don't know. That seems to be changing very quickly as well.
The American thought.
Yeah. I don't want to talk about this anymore.
Yeah,
Let's move on.
I'm getting mad now.
Yeah, I am going to have more. There is more to come about this.
Oh,
this
there's
is not
definitely
the last
not
time.
it. There's going to be a lot of back and forth.
Yeah, there's going to be a lot more back and forth, and also. I know for sure this is not the end of it because there's going to be other concessions like the VA thing we just talked about.
Yeah. That
before this rule goes into, let's say, full effect or has to be deployed, there will have to be changes because I only brought up that one specific thing. That is not the only problem. The sellers being, let's say, denied being able to take their highest and best offer from someone because VA is also another secondary effect. But anyways, let's move on in the interest of time. Second article today is home builder sentiment turns positive for the first time since July of 2023. U.S. home builders are feeling more confident about their businesses than they have since last summer as they see better demand despite stubbornly high mortgage rates. Home builder sentiment went positive for the first time since July 2023 and gained for the fourth straight month. Here's the biggest takeaway for me in this article, Brian, is that sentiment rose 3 points. That's and when we talk about terms of points, everybody, that's 3%. So home builder sentiment rose 3 points to 51 in the month of March. Now, for those of you who are new to the National Association of Home Builders Market Index Sentiment Report, 50 is considered neutral. Anything that is above 50 is considered positive or expansion. Anything lower than 50 is negative or contraction.
We're positive.
We are at 51.
We're positive.
But it flipped from 48 to 51, and it is the fourth straight month of gain, which means for 4 straight months it's been in the dump, and now finally peeked its head above into positive territory.
But I think the road looks a lot better than where it was a few months back. And I feel there's a lot more clarity. I could see the end of the tunnel, the light at the end of the tunnel. But I like what it said right here. Buyer demand remains brisk, and we expect more consumers to jump off the sidelines and into the marketplace if mortgage rates continue to fall later in this year. So that is true. And I've already been seeing it like just this past week and even starting today. I had a lot more people calling me to start the day, which was actually really nice. But what I am seeing that this talk about rates is kind of more transitioning to like, hey, yeah, rates are going to come down. That's already kind of like something that is forecasted, but homes, prices, inventory, and then, builders still facing challenges for, supply chains, building permits. It's still, very, very, very tricky out there, but things are moving in a more positive direction, which I feel is good. But again, there's still some sort of, we're not out of the woods yet.
Well, not out of the woods, but the sentiment does lead to decisions. And so sentiment does lead to building eventually. So you're citing a couple things that are standing in the way of builders. Number one was the scarcity of buildable lots. Number two, skilled labor. Number three, restrictive codes that continue to, number four, increase the cost of building homes. So it's kind of like they all kind of come together, and the first three end up creating the outcome of increased costs. But the fourth month in a row of this means something very strategic because October of last year was kind of like, oh my God, October of 2023 was ruthless. It was the highest mortgage rates we've seen in decades. Affordability was at its lowest. Everyone had like this shock in the month of October, and it happened in October. So basically in the month of November, everyone was like, holy crap, what was that? And then we started to see a little bit of that kind of thawing a little bit in December,
going into January.
And what they just say, 4 straight months of what? 4 straight months of positive sentiment. That would have started in December.
Yeah. So then moving forward, we're right on track.
I'm safe to assume that the assessment is that our sentiment as builders is better because we don't see October of 2023 being something that's going to be on our time horizon in the future anytime soon. Because if they're 12, 24, 36, 48 months from getting land, getting permits, getting code, getting
right
financing,
on there. They're just
getting dirt, then they're already looking through the
rough
crystal
patch,
ball, if you will, and saying, oh, okay, well, then I think in the next couple, years, we're going to be clear to fill this demand, make some money, and do it with some margin.
One of the things I do see very interestingly is that, builders do have that advantage where they could just, drop prices drastically and, make it more affordable for a buyer if they need to move that home.
Yeah, but there's a limit. You can't just drop it to the point where it costs you to make it. Then you make no money.
No.
So,
but those times where they do incentivize buyers to come, it does open up a lot more, a want for people in demand to get out there. But then once they go and actually see it, they're like, I got all the bells and whistles. Yeah, it still costs a lot.
Yeah.
So there's only so much that you can do on that. But once they start bringing your rate down 1 to 3% on average, it kind of makes it a little bit more easier for you to be like, okay, well, maybe the HOA is a little bit high. Melrose, okay, can't do nothing. But this, compared to a house that, has years on it, right now, it's kind of like, I'd rather go with something brand new and pay a little bit more than get into something else.
Yeah, that's the same price, but 40 years older.
Yeah, exactly.
it needs work. There's definitely that to consider.
But
that's in the psychology side of the
buying. But to your point, the builders aren't going to go in a crazy frenzy and say, hey, we're going to slash prices, everybody come buy a house from us.
No, they build homes to make money.
Yeah, exactly.
They provide shelter, but here's the bottom line. You follow the money. Yeah, they want to make money, and they can't squeeze out all their margin just because they got to move units. And look, I think the reason, there's a couple of reasons that this is all happening, but the sales conditions measurement raising 4 points to 56 also means something. And expectations in the next 6 months rose to 62. So builder expectations of the survey went to 62, which is still very, let's say, that's pretty north of the overall sentiment rising to 51. So their expectations over the next 6 months are positive and in clearly positive territory. So I think that is kind of like a nod to what I'm saying and what we're talking about, which is they're feeling pretty confident about what it looks like on the future to continue building homes and probably with less price cuts. Let's be honest.
I think it's good momentum going into the hot seasons for the market.
They are reporting that the fewer builders are lowering home prices there are fewer builders who have had to lower prices to attract buyers. And in March, 24% of builders reported cutting home prices, which used to be 36% in December, just a couple months earlier. So the same window of December through March, where there's 4 straight months of positive sentiment, you have that the amount of builders who had to cut prices significantly down from 36% to 24. So that is kind of like they go hand in hand. And I think that's also in line with projections of 2024. We talked about this on another show. We talked about the percentage of homes that experience price cuts compared to their list price. And it was like 36.2%, I think, in 2023. And it's only projected to be like 32% overall this year.
Oh, wow.
Yeah. So you're already seeing that at large beyond just the builders conversation. So I think incentives like you're talking about to buy down the rate, get certain upgrades, people buying a new home versus buying an old home that might need work now or in the next couple of years are definitely going to be motivators for buyers. It all comes down to them being able to qualify still. So you're a buyer looking to qualify, whether it's FHA, VA, or conventional, you got to talk to Brian, got to talk to Will here at the office, get yourself approved and get out there. I will also say, make sure you get your insurance lined up like right away, because if the builder does not have insurance solutions for you, you got to come up with an insurance solution between you and your lender so that you can get that declaration page to get your loan funded.
100%. If you're thinking of buying a house in 2024, check with your insurance provider already and say, hey, are you guys insuring homes in California? And if they're not, ask who is and try to get as much forward ground on that, because if you get down to the last bits and try to get insurance, guys, it's taking up 2-3 weeks, and in 2-3 weeks we are trying to close.
You're trying to close.
Yeah.
So thank you. Let's move on to the next article we have. Here's how mortgage rates have changed during the Fed hike. This is coming in from Forbes. We don't often talk about Forbes, but I saw this article I wanted to bring up to you, Brian. After hovering at record low of below 3% for much of 2020 and 2021, 30-year fixed rates have shot as high as 7.8% last fall. Ding, ding, ding. October of 2023. It has more than doubled home loan borrowing costs that have coincided with the Fed's dramatic shift in Fed funds rate. The Fed, back when this started in March of 2022, before they started hiking rates, the Fed was at 0.5%, and now are at the 5.25 to 5.5%. And has ended rate hikes as of last summer, but man, the ripple effects are painful.
So how much further will mortgage rates go down?
They are going to go down. I mean, you can see the chart. We'll probably flash. You know what? Let's flash the chart on the screen right now. You can see the correlation between mortgage rates in general, or average, and the Fed funds rate.
I wanted to go through a few points that they signaled, they mentioned here.
Talk about that.
The Fed wants 2.5 federal fund rate in the long run. Now, Goldman Sachs came back and said, I think it'll be closer to 3.25 to 3.5% due to lingering inflation, which we have been, the Fed, mentioning that time and time again, still not making their 100% decision, but they say inflation is still afloat. And then historically, rates sit about 2% higher than the 10-year Treasury bond, which highly correlates with the direction that the federal fund rate wants to move rates. So I feel that in the next coming months, maybe into 2025, rates aren't going to tank down to your 2%.
No, they can't. I mean,
at all.
You're already citing that the Fed wants to. They expect rates to go return to 2.5%. I think that's a little projection.
That is.
It's a big projection. Let's be honest. But here's the thing: if we're already at, let's say, 5.25 to 5.5. What is going to cause you to have a 3% swing to the downside? And if you do march it down, then that's going to be marched down over the same period of time we marched back up.
Yeah.
Because we marched up over 18, 20 months, you're going to march back down. Because if you just dunk it, that does have economic repercussions
100%,
right away. And part of what is being cited here by Goldman Sachs is the lingering inflation. I wrote here, inflated prices are now embedded. They just are. I don't know that people are going to agree with me. People that currently love what's happening in 2024 are probably going to be like, yeah, no problem. It's just the way it is.
Good.
And people that are like super angry about 2024 are going to be like, we're pissed off. Inflation sucks and it's never going anywhere. I'm just saying, mechanically speaking, inflation is embedded.
Yeah.
There are, I don't think any service or product I pay for is the same price or lower than it has in its peak. Now, if people are going to argue, oh, it's gone down. No. The rate of increase has slowed. Do not confuse that with a negative sign in front of the number, which would indicate going down.
Yeah.
So don't at me, oh, it was only 0.3 and now it's 0.1. No, that's still plus territory. Get it right. Understand how it works. It's cumulative compounding over time. It's not in decline unless there's a negative number in front of it and a negative sign in front of the number. Okay?
100%. We're wrapped. Done.
So here's the thing. So, closing out this part. So Goldman's projections about the 30-year mortgage rate, it is in conjunction with the 10-year yield. You can see it on the chart that there's this Fed funds rate marching up. Mortgage rates have marched up. And it said here, Goldman projections imply 30-year mortgage rates are likely to settle somewhere close to 5% when the Fed concludes its current cycle. From 2011 to 2022, mortgage rates never topped 5%. I'm sorry, Brian, real quick. How many years is that? 11. 11 years. From 2011 to 2022, mortgage rates never topped 5%. And now we're not even anywhere close to that unless you're talking about some certain government loans with down payments and all sorts of things. But they're citing, an 11-year time frame. I don't know that we have 11 years to wait. And
so you're telling me in another 11 years, we'll see rates come right back down.
Yeah.
Ladies, thank you.
Come back in 2035 and let's see if we were right.
So unless there's another catastrophic event like a black swan or something that I've constantly been hearing throughout the news and people kind of lingering, I don't know. But I am going to agree, and I think rates will drop to around 4.5% to 6% because I think that's a healthy, it's somewhere where it doesn't build up so much demand that it's literally just, chaos. But at the same time, everybody has a different tier. Some people are okay at 6%. Some people are okay at 4%. Some people, unfortunately, need to be at 2%. But then that comes at a different problem. Maybe your income needs to go up. Maybe your situation is a little bit different. Your debt needs to be shaved down. So there's a tier for everybody. I just don't think that 2%, 1%, even low 3% is something that's going to be healthy for, the market, because then we just see all this bent up demand. And then we go right back to high prices, high demand. We go madness.
It's going to ease certain things when it comes to credit, lines of credit, business credit. And it eases up some of those things. It may be like we'll take the chokehold off the neck of employment, that kind of thing. But there is a sweet spot where demand and supply can kind of come into agreement with one another. We're just not there yet.
Yeah.
And the Fed.
Fortunately.
Here's the weird thing: is that all things real estate related right now, the commission lawsuit and insurance is taking front and center when you think it'd be the Fed, but it's not. The Fed is like easily in third place at best.
They're kind of like, oh, thank God.
They are certainly not number 1 and 2 right now. So,
which is alarming because if that's not the most important thing, like, yo. We got bigger problems here.
Yeah, which we do. So here comes a bigger problem. We have State Farm to pull out of 72,000 California insurance policies. Yikes. This is from Insurance Business Magazine. We never cited them, but this was sent to me by a friend of mine in insurance. We have 30,000 policies, including homeowners, rental dwellings, and other property insurance for those of residential community associations and business owners being canceled or discontinued. And then you have 42,000 commercial apartment policies also getting discontinued.
So,
in addition to what's already happened.
I'll tell you that insurance policy for the apartment complexes is such a kick in the nuts because if we're trying to refinance a client and their complex didn't update certain things and they didn't get their records up to date, they don't have allocated budget, the insurance isn't covering enough of the dwellings that needs to be covered.
Yep.
You can't refinance, guys.
That's
you
right.
can't purchase that property in that house with the FHA or VA conventional loan if it doesn't meet certain characteristics.
Yeah.
So a lot of people think, oh, insurance, that's not a big deal. No, it's going to start affecting 30,000 people, 42 more. This is going to be a huge problem in the months to come as it starts trickling down into the months that they pull out. Well, something's going to break.
And let's clarify, commercial apartment policy sector. Yeah. I actually do not know if that includes the condominium complexes
like
that
residential
have more
and stuff
than
like that.
4 units. Yeah, because the other part of this is the residential. You're talking
yeah.
about a commercial apartment policy. So an owner who owns a commercial apartment, who has an apartment complex and has a commercial policy on top of that.
Yeah.
But if condos are tucked underneath that, I don't know if they are or not. If they are, what you're saying is 100% correct because your association has to have coverage. So that goes to the HOA part and the part above it. No, go. What were you going to say?
So I was going to say that the HOA, certain insurances, like just for them, like we had to get something updated for the client that we just refinanced.
Yep.
And they didn't have enough dwelling coverage. So the whole association had to update the policy.
Right.
Their fiscal year was due right here in July. So luckily they're like, hey, it's almost done. We can make it happen. But if they don't want to work with you, unfortunately, the HOA doesn't have to do it.
Right. Well, that's the thing.
That's so stressful.
You could be subject to whether or not they can get a policy, and if they then want to. So, can you, number one, and then will they, number two?
Yeah,
exactly. That is difficult. What's being cited here in the article is that they did an exhaustive review of the company's financial stability. They've been affected by various factors, including inflation, natural disasters, reinsurance costs, which are insurers of insurance companies, and then outdated regulatory frameworks. Our most recent conversations about insurance have been mostly unpopular in the comments section because people are like, yeah, F them. Who cares? We pay them. They can't pay us. And I agree. I understand what you're saying.
Yeah.
It is definitely a love and hate relationship.
Oh, yeah.
I love that I have insurance when I have a claim to make, like I did last year.
But I hate when I have to pay
really
every
hate
month.
paying a premium for a service I don't ever have to use. So it's like this. I like it when I need it. I don't like it when I got to pay for it, right? I get it. I understand. And I also understand that, at least what I've recently seen in our comments is there's no love lost for the insurance companies have to leave. Like,
no.
Hey,
later, bye.
Don't
let the door kick you on the way out.
I'm not mad. You all made billions of dollars last year. And it's like, I get it. I 100% get it. I understand.
So if they modernize the rate application and the frameworks, how would that alleviate high costs?
I think that just is more of a way to sneakily say we can have less people. We can rely on software who can help us more adequately do some of the same tasks without the high cost of having a person do it.
Got it.
I think that's part of it. I think a lot of this has to do with risk assessment and just identifying, are we even willing to take the risk to exist in a certain place? This is why you see people asking, okay, what's your zip code? They're doing Google Maps to look at people's yards. How close are you to a canyon? Are you in a place that is in a fire zone or next to a fire zone?
Oh, God.
Not just did you have a claim on your property, are you even next to a fire zone? I think there's that. And then you have the size of natural disasters that has basically depleted a lot of these resources. Yes, they still make billions of dollars, but here's the deal. In order to operate in the state of California, you have to remain solvent. So the Insurance Commissioner of California has standards and requirements for you as a company to be able to pay on the policies that you have been taking money from via premiums from people. So there's like this kind of buoyancy, if you will, that you have to maintain this solvency test in order to be in California. And if you are either failing that solvency test or you would potentially be failing it, you got a business choice to make right now. So they're either going to stay or they're going to go. And what you see right now is they're going.
Yeah.
So,
it just doesn't make sense.
This part of the show, for those of you who are watching that you currently have a State Farm policy, at least the article is saying that State Farm is going to be reaching out to everyone individually to send a letter to say whether or not you will be non-renewed or canceled. And then I would suggest that you really quickly try to find someone in your area that still provides the type of coverage that you are being canceled for.
Yeah.
Whether that is a local insurance broker, whether that is another agency that's a national agency. We have also covered an entire show on this topic on Friends of Mortgage Heroes. Go look at Friends of Mortgage Heroes episode 11. We had Farmers and State Farm here on the show. We also had Carlo, our good friend from Old Harbor Insurance. He's an insurance broker. Come on. Months ago, and he talked about this as well. They're either going to happen during your policy expiration date, or it's going to happen by this summer, depending on which type of policy we just mentioned is covering you. It could be, if it's one of the 30,000 policies for the homeowners, rental dwellings, and other property insurance, looks like that's going to start being canceled or discontinued July 3rd of 2024. And the commercial apartment policies look like they're about to start being canceled or discontinued August 20 of 2024. So as of right now, you got a couple months, but get on it. Don't wait
till they cancel your policy. Yeah, be proactive because it's going to come by quickly.
Yeah, this broadly comes down to what's going to happen at the insurance level at the state, with the state of California, and insurers decide if they're going to stay here or not, and if they want to come back. Look, no love lost, but also maybe loss of risk or increased risk for those of us on the consumer side. I mean, we have business here, we have property here, we have equipment here, we have our own possessions that we insure in our homes, our residences, here at the company, when we take gear on the road, all sorts of stuff. So,
it's like passed down risk. Like nobody wants to take the risk, so they're like, "Hey, we'll just not insure." It's like no insurance for your insurance, so no insurance.
Well, and depending on what topic and part of the insurance you're talking about, cost to replace, cost to repair, cost to rebuild varies by a lot.
Yeah.
So I know we had to kind of hurry through some of these last ones. Brian, any last idea or last thoughts on the insurance topic, other than get ahead of it right now? If you're a buyer, get your insurance in line as fast as you get your loan in line.
One of the insurance that I've been seeing a lot still pass through, and I'll link we'll put the link to them, is KW Insurance Specialty. They actually have been very good at still insuring properties here in California. And out of the 4 partners that I work with for insurance, all of them sent me them and basically said, hey, they already have them, so stay with them if they're already insuring.
KW Insurance Specialty.
Yeah,
okay,
KW
you're gonna have to send that.
Send it for. And actually, Carlo's the one that basically helps us out with that one. So yeah, just definitely, we'll put the information of everybody we use.
All right, cool. Quickly, what was the favorite part of your show today?
Friend and Center, the NAR lawsuit.
The lawsuit. Oh
man, I think the memes, the internet, and just the general public is gonna have a good one with this one. And I feel I think it's a long time coming. I feel there's going to be a lot of reform, a lot of more clarity, and hopefully for both sides, for agents as well as for consumers, to get a little bit more on the curve of learning what's happening in real estate day in and day out, or pay the fee.
Yeah.
Or pay the fee.
Yeah, that's actually the same thing for me too. I'm very intrigued by this article because, again, before anything goes into full force action, there's going to be other things that have to get reconciled because this is running into gridlock points of certain laws that say you can and can't, and who can and who can't, and why they can or can't. And that's all going to have to get settled out when the dust settles. It'll all be resolved. But I think we're going to have to come back and talk about this topic when more things are known, because this will change. This will dramatically change for most people. For most people, this will dramatically change what the real estate landscape looks like for them as professionals and as consumers. Whether you are a seller of real estate or you're a buyer of real estate, new things are coming, and you need to stay tuned so you can know what's going on, what your options are, and then what the potential costs are and opportunities. There will be opportunities out of this. You may not like them, but there will be opportunities. So, Brian, thanks again for watching. Thank you to all of you for watching the Mortgage Heroes Weekly Podcast. Remember to subscribe to the channel, like the video, and forward this to someone you know and love and care about. And then check out our playlist called Friends of Mortgage Heroes, where Brian, myself, and Will interview our friends in and around real estate, talking about success and failures, things that we can learn about and share with you on your journey to have real estate and mortgage and finance and personal success and business success as part of your life. So make sure to check that out, and we'll see you again next week.
Yeah, that's it. Thank you, guys.